A consultancy firm is warning that some pensioners may have to start setting money aside for out-of-the-blue tax bills. Frozen income tax thresholds coupled with a bumper state pension increase next April could push more pensioners into paying tax. Consultants LCP, Lane Clark and Peacock, warned that growing numbers of pensioners could be pushed over the tax threshold based purely on a state pension, adding that there is no automatic way of collecting the tax that they owe, because state pensions are paid in full, before the deduction of tax. In such cases, Revenue and Customs, HMRC, could operate a system known as Simple Assessment. Under Simple Assessment, the Department for Work and Pensions, DWP, would notify HMRC at the end of a tax year how much state pension people have received. If this takes someone over the income tax threshold, there would be a tax bill to be paid. LCP said HMRC may write to the pensioner after the end of the tax year telling them that they have not paid the tax due on their state pension and requiring them to make a payment before January 31 the following year. It warned that pensioners could have received, and spent, all of their pension during one financial year only to receive a tax bill on that pension the following year. For pensioners who have a state pension and a private pension, the state will collect any tax due through the code applied to the private pension. The income tax threshold has been frozen at £12,570 since 2021-22. This could mean pensioners receiving over £242 per week would owe some income tax. LCP said that online statistics from DWP indicate that, as at November 2020, over 2.3 million pensioners had a state pension of £195 per week or more, and taking account of state pension increases since then, these people would now have a pension over the tax threshold next year. While some of these pensioners will have private pensions that can be used to collect any tax due, others will have large state pensions precisely because they did not make alternative private provision, it said. LCP estimates that around 1 in 5 of these pensioners, or more than 400,000, may have no other source of income from which HMRC can collect the tax owed. This is the group who are now at risk of getting unexpected tax bills and may need to consider setting aside some of their state pension each month so that they have the funds available to pay a future tax bill, it said. Sir Steve Webb, a former pensions minister who is now a partner at LCP, said, "Millions of pensioners have been dragged into the tax net for the first time in recent years, primarily because of the multi-year freeze on tax thresholds. Many are now at risk of an unexpected letter from HMRC asking for tax they may not have realized was due. Any pensioner with a pension next year over £242 per week will have tax to pay, and if they do not have a private pension through which the tax can be collected, they may need to set some money aside for an unwelcome tax demand." LCP believes many of those who could be hit by unexpected bills could be receiving the old state pension, having reached their state pension age by 2016. Those on the maximum basic state pension would see payments rise from the current £156.20 a week to £168.40 under an uprating of 7.8% and £169.50 with 8.5%. The full, new state pension is currently £203.85 per week. Operating using the lower wages growth figure, 7.8%, would see people receive £219.75 each week, while under the 8.5% figure it would be £221.20. if the UK government chooses to uprate state pensions using the lower wages growth figure next April, 7.8%, it would see millions of pensioners miss out on an extra £75 in 2024. However, experts warn that any attempts to amend or break the triple lock ahead of a general election could be costly for the Conservative Party with a looming general election in 2024. Estimated state pension payments from April 2024. The estimated calculations show the current annual rates for the full new and full basic state pensions. The monthly payment calculated below refers to every 4 weeks. There are 13 payments made throughout the year. How much someone receives depends on the number of years' worth of national insurance contributions. Around 35 is needed for the full new state pension, but this may be more if you were contracted out. Find out more here. These estimations are based on the wages growth at 7.8%, excluding employee bonuses, and 8.5%, including employee bonuses. Figures have been rounded using the UK government's rounding policy. Current annual full new state pension, £10,600 weekly, £203.85 every 4-week pay period, £815. 47.8% uprating April 2024, £11,427, up £827, weekly, £219.75 every 4-week pay period, £879. 008.5% uprating April 2024, £11,502, up £902, weekly, £221.20 every 4-week pay period, £884. 80 current annual full basic state pension, £8,122 weekly, £156.20 every 4-week pay period, £624. 87.8% uprating April 2024, £8,756, up £634, weekly, £168.40 every 4-week pay period, £673. 55.8% uprating April 2024, £8,814, up £692, weekly, £169.50 every 4-week pay period, £678. 00 Pension B has an inflation calculator which enables people to see the impact of inflation on their pension savings. You can try it out here. Get the latest record money news. Join the conversation on our Money Saving Scotland Facebook group for energy and money saving tips, the latest benefits news, consumer help and advice on coping with the cost of living crisis. Sign up to our Record Money newsletter and get the top stories sent to your inbox daily from Monday to Friday, including a special cost of living edition on a Thursday. Sign up here. You can also follow us on X, formerly Twitter, at @RecordMoney_ for regular updates throughout the day. Earlier this week, Downing Street refused to guarantee that benefits would rise in line with inflation or that the triple lock for pensions would be based on earnings including bonuses. 8.5%. The Prime Minister's official spokesman said previously, the Secretary of State has to conduct his statutory annual review of benefits and state pensions using the most recent data, including, obviously, today's figures. So that process will take place. A Treasury spokesperson said, our older population have the right to security and dignity in retirement, which is why this year we provided the biggest ever cash increase to the state pension, a 10% 1% rise, which comes on top of extra direct cash payments worth up to £1,350 each to support with cost of living challenges and protection from rises in energy bills. We have taken 3 million people out of paying tax altogether since 2010 through raising the personal allowance, and the Chancellor has said he wants to lower the tax burden further, but sound money must come first. Join the Daily Records WhatsApp community here and get the latest news sent straight to your messages.